Welcome to the natural rubber market review. When I presented the short-term outlook last Monday, I shared a number of observations on the expected performance of natural rubber prices during the last week. The observations made last week were, first, physical markets will get strong support from a seasonal shortage of natural rubber. That was one important observation. Second, latex price will perform relatively better than TSR or technically specified rubber. Third observation was that futures markets need not fully reflect the favorable conditions prevailing in the physical market in the form of seasonal low production and tight supply. Futures market need not reflect these favorable factors because futures market will be weighed down by a number of factors which can prevent or discourage speculative investment. So these were the three observations we made last week about the likely performance of natural rubber price during last week. So let us look how natural rubber prices performed last week. Just have a review of last week. We start with the TSR, technically specified rubber, and there are two important markets for technically specified, physical market for technically specified rubber. One is STR20 market, FOB market, Bangkok. So Bangkok STR20 averaged 2.4% higher during last week compared to a week before. Another important market for STR or TSR is SMR20 market, FOB Kuala Lumpur. So SMR20 FOB Kuala Lumpur averaged 2.0% higher during last week compared to a week before. Then coming to latex markets, physical markets, Bangkok markets. There are two markets, important market for latex. One is Bangkok and the other is Kuala Lumpur. Bangkok market averaged to 6.1% higher. Bangkok market of latex averaged 6.1% higher during last week compared to a week before. So just compare in Bangkok market, just now we have mentioned that TSR20 averaged 2.4% higher in Bangkok markets. In the same markets, latex price averaged 6.1% higher. That means we have predicted latex performing better than TSR, and exactly, and this actually 3 times higher, means 2.4% higher was the increase in the case of 2.4% was the increase in the case of TSR, but in the case of latex, the increase is 6.1%, the same market. When coming to Kuala Lumpur latex markets, Kuala Lumpur latex prices averaged 3.6% higher during last week compared to a week before, 3.6%. But in Kuala Lumpur itself, SMR20 averaged only 2.0% higher. So here also, latex markets performed considerably better or higher than the TSR grade. So exactly means latex prices average relatively higher than TSR both in Bangkok and Kuala Lumpur markets, exactly in the way we expected or predicted. Now coming to RSS, ribbed smoked sheet, we have two important markets. One is RSS Bangkok, RSS3 Bangkok, and other is RSS4 Kottayam. RSS3 Bangkok averaged 4.5% higher. 4.5% higher during last week compared to a week before. But coming to Indian market, it's a Kottayam Indian market, Kottayam market in India, the RSS4 price averaged 0.5% lower. The most prominent grade or popular grade in India is RSS4, and that average 0.5% lower. So lower in Kottayam because of some specific domestic factors. So in India, especially in the state of Kerala, which is producing more than 70% of country's total production of natural rubber, the seasonal shortage has not, seasonal low supply period has not started, because it is the wintering season or off season is expected to start only by the last week of February. So that means supply is not affected by the withering or defoliation of tree, not affected. At the same time, when we look into the other side or demand side, tire companies, auto tire companies have been less active in the market during last week. So this is a specific situation. Indian market performed different from the rest of the world due to specific domestic factors. So this is a review of the last week. And we look into the coming week, or what can be expected during this week. First, we should consider the key influencing factors. We have three important factors, influencing factors to be discussed. We are expecting for this week. First of all, most important thing, apart from demand and supply, most important thing is heightened geopolitical tension between Russia and the US-led West over Ukraine. So what are the implications of this geopolitical tension for speculative investment? Geopolitical tension means investors rush to safe haven currencies. In a situation of risk and uncertainties, usually speculative investors will park the amount in safe haven currencies or other assets, similar assets. So investors will rush to safe haven currencies, including dollar. That means a dollar will be gaining during this week, and a strong dollar makes speculative investment less attractive. Or in other words, geopolitical tension adds risk and uncertainties in speculative investment. So that will be reflected in the futures market. So the heightened geopolitical tension over Ukraine will be weighing down the futures market. This is first important factor. Second important factor, US inflation hits 7.5% in January 2022. 7.5% means this is the highest, or usually inflation we say hottest in 40 years. So what are its implications? Very high inflation means that is adding further pressure on the US Federal Reserve to hike policy interest rates. So there will be a higher pressure on the Federal Reserve to move more quickly to adopt or to implement hawkish policies, or means aggressive hawkish policies, or there will be more forcefully, they will be implementing the rate hike more forcefully than earlier time. According to officials, quoting officials in the Federal Reserve, there have been report that earlier Federal Reserve was planning to increase the interest rate by only 0.225% in March. Now they are considering to increase the rate, increase the policy interest rate by 0.5. That means the extent of rate hike may be higher, and it may happen sooner. So the resultant higher borrowing costs and stronger dollar make speculative investment unattractive, or speculative investors in futures market will be extremely cautious on fear of imminent and aggressive hawkish policy step by Federal Reserve. So that means we have two important factors dissuading or discouraging speculative investment. One is geopolitical tension over Ukraine, and the second is imminent and aggressive policy intervention by the US Federal Reserve, which can make interest rate higher, borrowing costs higher, and dollar stronger. These are two negative factors exerting downward pressure or keeping the sentiment down in rubber futures. Then coming to the physical market, a further tightness in global supply of natural rubber is expected during this week, because more number of farmers have reportedly stopped tapping to give tapping rest to the trees during the refoliation period. Refoliation means after leaf falling season, young leaves will be coming. During that particular season, maybe it may start for a few weeks, farmers will be giving tapping rest, and this tapping rest or the refoliation period will vary from country to country, slightly vary from country to country. it can vary within each country. This can vary from region to region, and even within the same region, this can slightly vary according to the crop, according to soil condition, and there are several other factors. So that means because farmers may be giving tapping rest at different point of time during the coming 2-3 months. Then coming to the looking into the demand side, demand is expected to perform better than the previous 2-3 weeks because China's manufacturing and trading activities have returned to normal after the long holiday for the Spring Festival. China is accounting 43% of the global demand for natural rubber. China was closed down for 2 or 3 weeks because of the long Spring Festival holiday or Lunar New Year holiday. Now Chinese activities have resumed. So that means that this week we are expecting more activities in China, means more rubber is consumed or imported in China. This is something positive. So we have a mix of negative and positive factors. Negative means we have highly favorable supply demand fundamental in the physical market. We have seen supply low and the demand is improving, especially from China improving. So we have a favorable supply demand fundamental in the physical market. This is a positive side. But in the futures market, speculative traders are likely to adopt an extremely cautious step in view of the risks and uncertainties arising from the two factors we mentioned. One is Federal Reserve's hawkish or aggressive policy intervention, and the geopolitical tension over Ukraine. So putting it in briefly, market fundamental is strong. Market fundamental is strong, but the ecosystem for speculative investment is unfavorable. So this is a very particular, very peculiar situation coming this week. We have a strong market fundamental, but at the same time, ecosystem for speculative investment is not favorable. So the questions here: will the strong market fundamental, or that means a tight supply and relatively better demand, will help rubber futures to offset the negative sentiments arising from the two factors we mentioned, that is Federal Reserve's intervention and geopolitics. So our question, whether this strong market fundamental will help futures market to offset those two negative sentimental factors. Then another way of looking at this: will the negative sentiment prevailing in the futures markets offset the favorable conditions or nullify the favorable conditions prevailing in the physical market? So that can also happen. So that means we have one strong physical market condition. At the same time, we have unfavorable conditions prevailing in the futures market. So let us see how the two opposite forces are going to play during the coming week. So we will see again at the next episode on next Monday at the same time. Thank you all.